There's one truth most investors hate to hear. Nothing goes up forever. Not stocks, not gold miners, not even the strongest bull markets. And right now, while many people are celebrating small pullbacks like they're once-in-a-lifetime buying opportunities, the reality might be very different. What if this is not the dip, but just the calm before a much bigger move? What if the real opportunity hasn't even started yet? Welcome to Gold Silver Scope, where we break down the gold and silver markets with clarity, logic, and real insight. Right now, the market is showing a minor retreat, and many investors are rushing in thinking it's a sale. But let's slow down and think logically. A small pullback after a strong run is not automatically a bargain. In fact, in many cases, it's just a pause before the next phase, and that phase could easily be downward before moving higher again. Smart investors understand timing matters just as much as conviction. When it comes to mining stocks, the situation becomes even more critical. The harsh reality is that the majority of mining companies worldwide simply don't have real value. In fact, it's fair to say that nearly 90% of them are essentially worthless in terms of long-term investment quality. They exist more on hope and promotion than on actual assets or production strength. That means the overall market often looks more attractive than it truly is. But when you filter out the noise and focus only on the top-tier companies, the picture changes completely. A small group of high-quality producers and well-positioned companies hold real value and real potential. These are the ones that matter. Everything else is distraction. Now let's zoom out and look at the bigger picture. Over the next decade, there is a strong possibility that the purchasing power of the US dollar declines significantly. Not overnight, not in a straight line, but gradually over time. And when that happens, assets like gold tend to reflect that shift. Gold is not just a commodity, it's a form of financial protection. It doesn't promise profits, but it protects purchasing power. That's why seeing gold around $4,700 shouldn't be shocking. In fact, if you think about it, this level is simply a reflection of the world we are living in today. Years ago, people speculated that if global tensions increased, if economic uncertainty grew, and if financial systems became more fragile, gold could reach these levels. And now, we are here. So the real question is not, why is gold this high? The real question is, has the market already priced in the reality of the world we are facing? Because gold doesn't just react, it anticipates. And if that's true, then what we are seeing today may not be the end of the move, but just part of a much bigger story that is still unfolding. To truly understand what's happening in the gold and silver market, you need to separate short-term noise from long-term reality. Many investors get confused because they focus too much on daily price movements, headlines, or geopolitical events. But historically, gold doesn't move primarily because of fear or war headlines. It moves because of something much deeper, the loss of purchasing power. Over time, currencies weaken. This isn't an opinion, it's a pattern. Governments print money, economies expand on debt, and central banks adjust policies to manage growth and crises. All of this slowly reduces the real value of money. And that's where gold comes in. Not as a speculative tool, but as a long-term store of value. Interestingly, in the short term, gold can actually move in the opposite direction of what people expect. For example, when the US dollar becomes stronger, gold often faces pressure. This is because gold is priced in dollars, so a stronger dollar can temporarily suppress its price. This creates confusion, especially for new investors who expect gold to rise immediately during uncertain times. But this is where understanding time frames becomes critical. In the short term, currency strength, interest rates, and liquidity conditions dominate price action. In the long term, inflation and currency debasement take over. And when you zoom out far enough, Gold has consistently shown its ability to maintain value while fiat currencies lose theirs. Another important factor that many people overlook is gold's role as liquidity. Gold is not just something investors hold, it's something governments rely on. During times of crisis, countries don't sell gold because it failed. They sell gold because it works. It is one of the few assets that can be quickly converted into cash without relying on another party. This dual role of gold, as both a store of value and a source of liquidity, is what makes it so powerful. On one hand, it protects against long-term currency erosion. On the other, it provides immediate financial flexibility during stress. Now, when it comes to mining stocks, things become even more complex. These stocks offer leverage to the price of gold and silver. That means if metals go up, mining stocks can outperform significantly. But the opposite is also true. If metals correct, mining stocks often fall harder. This is why even strong companies are not immune to market corrections. A great business does not guarantee a stable stock price, especially during liquidity events. In a situation similar to 2008, where markets face a liquidity crunch, investors don't sell what they want. They sell what they can. And that includes even the best assets. So while there is a strong case for undervaluation in some high-quality mining companies, that alone is not enough to protect them from short-term downside. If gold pulls back, these stocks will likely follow. That's why patience becomes one of the most valuable tools an investor can have. Instead of chasing small dips, experienced investors often wait for real opportunities. Moments when fear is high, prices are deeply discounted, and liquidity is available to take advantage of it. Because in the end, success in this market is not just about knowing what to buy, it's about knowing when to buy. As we move forward, the market is entering a phase where discipline will matter more than ever. Right now, there are clear signals building beneath the surface: rising global tensions, concerns around credit markets, and the possibility of liquidity stress. None of these guarantee a crash, but they create the kind of environment where sudden and sharp market moves become more likely. And if such a scenario unfolds, it won't be selective. It won't only impact weak companies or overhyped sectors. In a true liquidity event, everything gets sold. Prices fall not because assets lose value overnight, but because the system demands cash. Margin calls, forced selling, and panic behavior take over. This is where most investors make their biggest mistake. They enter the market fully invested, with strong conviction but no flexibility. And when the real opportunity arrives, they have no capital left to act. They understand what's happening, but they can't take advantage of it. That's why holding cash is not a weakness. It's a strategy. Liquidity gives you power. It gives you the ability to step in when others are forced out. It allows you to buy quality assets at prices that were unimaginable just months earlier. In the gold and silver space, this becomes even more important. Yes, the long-term outlook for precious metals remains strong. Yes, there is a strong argument for higher prices over time, but that does not mean the path will be smooth. There will be volatility, corrections, and moments of extreme fear. And those moments are where real wealth is built. Smart investors are not chasing hype. They are preparing. They are building watch lists of high-quality companies, looking for strategic opportunities, and waiting for the right conditions. This includes companies with strong assets, real production, and potential for future growth or acquisition. At the same time, it's critical to avoid the trap of low-quality names. Just because a stock is cheap doesn't mean it's valuable. As discussed earlier, a large portion of the mining sector simply does not have the fundamentals to justify long-term investment. Buying these companies just because they are down can lead to poor results. The goal is simple: protect capital, stay patient, and act decisively when the real opportunity appears. Because at the end of the day, Investing is not about being emotionally attached to gold, silver, or any single narrative. It's about making smart decisions, managing risk, and positioning yourself for long-term success. If you want clear, simple, and powerful insights like this on gold and silver markets, make sure you stay connected with Gold Silver Scope.